3 weeks ago, Trump told CBS the Iran war was very complete. Oil was at $91 a barrel. It is now above 113. And Brent crude just posted its steepest monthly gain since the 1990 Gulf War. The market stopped believing the president. That is not a political judgment. It is a trading signal. Each Sunday evening, Trump posts threats or peace hints on Truth Social to talk oil down. Each Monday morning, the market opens higher in crude. The mechanism is the Strait of Hormuz. Before February 28th, more than 100 vessels transited the strait daily. That number is now fewer than 5. Iran is not just blocking oil, it is charging tolls. Countries are paying millions of dollars for safe passage. That is 20% of the world's oil supply effectively under Iranian pricing control. The IEA released 400 million barrels from strategic reserves. Prices kept climbing. SocGen is now forecasting $125 Brent as a base case in April, with spikes toward $150 if Houthi forces shut the Red Sea corridor. Gas at the pump hit $3.99 nationally on Monday, up from $2.98 in February. That $1 increase translates to roughly $35 less in monthly disposable income per household. Moody's flagged that higher oil pushes up not just gas prices, but transportation, raw materials, and packaging throughout the supply chain. The oil shock is not just at the pump, it is repricing everything. The Federal Reserve cannot fix this. That is not an opinion. That is what Jerome Powell said at Harvard on Monday. The Fed's tools, in his words, have no meaningful effect on supply shocks. That sentence matters enormously. For 2 years, markets held on to a rate cut narrative as a buffer against bad news. Every inflation print that came in hot was explained away as temporary. Now, Citi's chief macro strategist says inflation has flatlined at 3% and is about to move significantly higher. The combination, inflation rising from a supply shock that the Fed cannot address while growth softens, is the textbook definition of stagflation. Powell said the Fed is positioned to wait and see. Translated, no cuts are coming until the war trajectory clarifies. The 10-year Treasury yield fell slightly on Monday, but bond auctions last week drew weak demand as investors grew more nervous about fiscal spillover from the war. Dallas Fed manufacturing declined in March. If the services and manufacturing data continue to weaken while CPI climbs, the Fed faces its worst scenario, a stagflation trap where cutting rates feeds inflation and holding rates deepens the slowdown. The equity markets bet on a soft landing just got significantly more expensive to maintain.
The critical variable now is whether U.S. ground forces enter Iran. The 31st Marine Expeditionary Unit has arrived in the region. The 82nd Airborne is en route. The Pentagon is reportedly planning weeks of operations, including a mission to secure Iranian uranium stockpiles and potentially seize Karg Island, the hub for 90